Hello, everyone. My name is Lucian. Most of you know me from Twitter as Triangle Investor. My guest today is Scott Melbye. Scott is the CEO of Uranium Royalty Corp and a executive vice president for UEC, Uranium Energy Corp. Scott, welcome.
Well, it's great to be here, Lucian. What a pleasure to be on your program.
Thank you very much. I had the pleasure to meet Scott in person and talk with him in a few occasions, and I can tell my audience that he's one of the most knowledgeable person when it comes to uranium and nuclear energy, and all that comes from a 40-year of experience in the industry. Scott, let's start with the macro, and we will go there for corporate developments. You were in my neighborhood recently. It was a nuclear fuel conference in Slovenia. How was there? Any deals for UEC?
Well, it's been really interesting. We've had two major global nuclear fuel conferences in the last couple months. One was in The Hague, Netherlands, and this last one in Slovenia. And really interesting to see kind of the market come to grips and realization of supply and demand fundamentals, the geopolitical impacts of Russia, Ukraine, and just the growth prospects for nuclear power. With, I think, the energy transition, we've hurtled towards a green energy, lower carbon economy, but I think we've come to a conclusion now that we had too much wishful thinking and ideology and not enough math and science in this shift in energy policy. But I can tell you there's nothing more math and science than nuclear energy, and it's really nice to see both political left and right supporting nuclear. In my country, the United States, Republicans and Democrats agree on very few things, but they do agree on nuclear power today. So that's a really great opportunity for our industry. So I think at those conferences, there's excitement that the industry is growing again at really robust levels, but there's also a bit of sober realization that we need to build out a lot of nuclear fuel cycle infrastructure in uranium conversion, uranium enrichment, even with or without events in Ukraine. There's a realization that the industry fuel cycle needs to catch up to the nuclear power plant growth.
Have you ever seen these kind of fundamentals in your 40-year career?
Yeah, I mean, we've seen periods of growth in nuclear power, and one of the big growth periods for nuclear was during the Arab oil embargo, when there was a realization that we needed to diversify our energy sources and be more energy independent. So it feels a bit like that. I think more recently you have the uranium, the bull market in uranium in kind of 2007 to 2010, in that time frame. I think there's a lot of similarities in that, but I think the story is probably more robust this time around because we really have a lot less inventory overhang and excess production and secondary supplies to help buffer what is really a supply shock coming soon, 2024, 25, 26. Utilities are saying that themselves, that they see not a tightening, but a shock, a real shortfall in that period. So I think we have seen elements of what's happening now, but I have the feeling that we're getting all of the elements of those past bull markets all coming in a greater magnitude this time around, which is a great investment thesis. Uranium is not the most efficient commodity like copper, gold, silver, other commodities that are more mature. We tend to have inefficiencies that when the market is oversupplied, it's painful because the market goes down to levels far below what is the incentive price or global cost thresholds for new mines. The market stays in a depressed levels for much longer than you would expect. But those same inefficiencies, when the market switches to an undersupplied mode and a scarcity mode, they tend to work in the opposite direction. And I think you could see uranium prices, increase well beyond what is the incentive threshold or a theoretical market clearing equilibrium price for uranium. We've never found that equilibrium point. We've always been either way below or far above that.
Yeah, definitely. But let's go to a little bit shorter frame. How do you see spot price performing in the next 6 months?
Yeah, it's been interesting. We've had quite a run. I mean, if you look at the low point in 2016, uranium was trading at $17 a pound. We're now trading in the $56 to $57 a pound range. Yeah. So it's been quite a rally. It's probably one of the best performing commodities year to date. And it's happened on, and a lot of attention in our industry has been put on the entrance of financial players and speculators like Sprott Physical Uranium Trust, which has had a profound impact on liquidity in the spot market and basically clearing material, any excess material off of the market at this stage. But these increases in the last few months and really year to date has been on demand other than those financial speculators. It's been utilities that like Diablo Canyon in California that the governor was shutting down in 2025 and now has flip-flopped and said, no, we need that critical, 9-10% of California's grid to continue online. And so there you had a utility that had no uranium contracts in place. They were winding down operations, had to come to the market and buy all their needs, uranium conversion enrichment for the next 5 or 6 years. So that's had a positive impact. There are other utilities in a similar situation as, utilities in Belgium and elsewhere, and even Sweden now. All the countries are reversing sort of this either diminished emphasis on nuclear power or phase out of nuclear power are now just going the other way. And that causes some existing nuclear power plants to be very low on forward supplies of fuel. So they're coming to the market. We have a new physical player that's emerged out of Zurich called Zuri Invest, which have raised $100 million to buy physical uranium in a bit of more of an open-ended physical uranium ETF. So all these things have put a nice support under the spot price. We've kind of been trading now in the $56, $57, $58 range. And I think, the next leg is definitely up. We may be pausing here a bit, but I don't see any conditions that could cause the price to really fall materially from this level. It can fluctuate, but the trend is up.
Can you tell me how many, I know you don't know the exact answer to this question, but how many material is available for sale on the spot market? I know you can say the exact answer, but do you have any opinion on how many material is available? Is the spot market drying up or not?
Yeah, I mean, the supply is drying up. I think it's very easy in our industry to determine how much nuclear power plants consume each year because it's very steady. It's 24/7 baseload power. It's very predictable.
Yes.
We also know how much is being produced each year, and that is a significant, the world consumes about 195 million pounds a year, and we've been producing at 130, 140 million pounds for several years now. So there's a significant gap. So that gap has been made up by inventories and secondary supplies, of which were obviously very significant because the market's been balanced at that depressed level. What we're finding is that with the production discipline, when miners in Canada, the United States, Australia, Africa, all either cut back production, shut in production, Uranium Energy Corp was no exception there in Texas and mines in Wyoming. That really was rebalancing the market. It was drawing down the excess. The speculative buys like Sprott and others, and even UEC and URC, together bought almost 8 million pounds of uranium off the market. That has really had the impact of rebalancing the market. And I know this sounds like a profound statement to make, that the market has rebalanced, but I think there's general consensus that it has, and that the excess supplies that have overhang above the spot market are now gone. It doesn't mean that there isn't some churn of spot materials amongst traders, and obviously there's still material trading in the spot market, but there aren't fresh supplies coming into that spot market, and any amount of demand like we've seen recently that comes into the market certainly will cause the uranium price to increase and could be quite significantly going into next year. So again, I think the takeaway there is that we've gone from an oversupplied, inventory-driven market, which we've had for many decades, to now finally in 2023, it's a production-driven market. So the price formation and the next pound to meet the marginal demand in the market is coming more likely from a produced pound and not an inventory pound that has a potential zero cost base. So now matters that mines get permitted, that mines start up. We have, some exciting developments where there are some mines either restarting or are breaking ground on new production, but they need to ramp up and achieve those production levels. And frankly, we need a lot more mines beyond those that we can kind of easily identify. And that's where the market gets really, really interesting. Between now and 2030, I think 8 to 10 new mines need to be built worldwide and brought online. Some of those are restarts like UEC's mines in Wyoming, Texas, like Paladin's mine in Namibia. But the new mines coming on, like maybe Global Atomic in Niger, yes, and others that are new mine developments are going to be needed. And if they're not permitted, licensed, or financed at this stage, there could be quite a gap. It could be 5, 6 years, 7 years before some of these mines could come online. So price could go way above that incentive price, and we won't see a flood of material in the case of uranium.
Do you see a scenario where U.S. Department of Energy buying more material for strategic reserves?
I hope so. We, as head of the Uranium Producers of America, that's one of
by the way, congrats on that. Sorry.
Thank you. Yeah, no, it's second consecutive term there, but it's definitely one of our priorities on Capitol Hill. Is we believe strongly that Russian uranium, for many reasons, both commercial and ethical, we need to move away from sending $1 billion a year in nuclear fuel purchases to Rosatom, which is integrally involved in the war effort in Ukraine. So we need to ban Russian uranium. That's one of our priorities. We think it can be done that doesn't harm utilities. There can be waivers for utilities that demonstrate a hardship if they lost those supplies on short notice. But the second part of that is that there is a realization we need to revitalize not only the uranium industry to respond to shifting away from Russia and perhaps Kazakhstan, but we also need that to happen in conversion and enrichment. So we did have the first tranche of the Strategic Uranium Reserve awarded in late last year, and deliveries were made to the DOE this year. UEC was a recipient in that award. We got the maximum amount allowed at 300,000 pounds at a $60 price in a $50 market. So it benefited ourselves and 4 other U.S. producers, miners, and the conversion facility. So we would like to see that program continue. The thing is, there's good news, bad news. It was just to focus on uranium at that stage. Now the problem's gotten bigger. It's gotten, now we're looking at uranium conversion enrichment. So we have more eyes and more urgency on our issues, but we're now a bigger program, and maybe as much as $3-4 billion program. And so that runs up against fiscal conservatives in the Congress, and particularly in the House now controlled by Republicans. Obviously spending is trying to rein in that government spending. So we're going to have to make arguments for that spending. And early indications are that Congress does see this as a priority. I think there's no question a ban on Russia has bipartisan support. Funding of the nuclear fuel cycle in the U.S. has support. I think there's just a degree of how much will that spending be and what will it look like? Will it be government purchases? Will it be production tax credits? Will it be cost sharing? But good news is everyone realizes we have a problem. And so I would expect we'll see legislation. We've had bills come through committee in the Senate and the House doing just that. So it's something just getting these bills on the floor of the Senate and House for full votes and hopefully signature by the president. But Washington works slowly. They're going into the recess period of summertime.
Yeah.
So something that'll have to happen, after the summer recess going into the fall.
Got it. My next question for you is Kazatomprom and China relations in the terms of U3O delivery. How do you see that cooperation in the future?
It's huge implications. If your viewers, have been following the uranium market for some time, we all recall the impact that the floods at Cigar Lake and McArthur River mines in Saskatchewan, the impact that had on the market back in the day. I think this has much bigger impact because we now have the situation where Kazakhstan is producing 57 to 60 million pounds annually. 40% of global supply comes from that one country. And if we are going into a situation where Russia is sanctioned, either self-sanctioned by utilities or formally sanctioned by the EU and US, the strategic nature of Kazakh uranium to Russia becomes even more important. They need that uranium for their reactors and for their client state reactors in places like Belarus, Iran, Egypt, Turkey. So it's not surprising that the Russians control or own 50% of Kazakh uranium today. So that left the other half of production that many in the West thought would be coming our way. And a lot of contracts have been signed to do that. Now, it's been very difficult with the sanctions environment for uranium to make it out through Azerbaijan, Georgia, and out through the Black Sea. It's been done twice now, but it was 10 times the cost of shipping out of St. Petersburg, Russia, and it's not easily reproduced on a big scale. So, there's been a lot of focus on those transportation issues, but I think that's all going to be academic because, as you said, the Chinese have increased their ownership in mines and JVs in Kazakhstan. They've signed huge contracts for the uranium output of the mines they don't control. And they've established a global trading hub in Alashanka, which is a Chinese border town with Kazakhstan that they've established. They call the global trading hub in Alashanka. And that all sounds really good. And it sounds like it's a benefit to global uranium trade. But what that really means is every container load of uranium that goes from Kazakhstan into China, into Alashanka, is not coming out. It's going, they may allow it to be traded in some way, shape, or form at that trading hub, but the uranium is ending up in a Chinese reactor. And I don't blame the Chinese. They have one of the fastest growing nuclear power programs in the world, or the fastest. They'll surpass the US in this decade at this pace. So they're really taking a strategic view to lock down their uranium supplies in a way that maybe US utilities aren't going to that degree. And I don't want to paint broad brush because there are utilities that are contracting and they are taking active steps, but the Chinese just take it one step further. I mean, in one way, we're playing chess and they're playing checkers when it comes to global uranium supplies. They're locking up Kazakh supplies. They're locking up Namibian supplies. Namibia is one of the top 3 uranium producers in the world today. So this has big implications because it's really going to be a big push for Canadian, American, Australian producers, maybe African producers that don't have Chinese control. Yeah. Really will see a premium and a lot of attention on those mines that aren't controlled by China or Russia.
Yeah, so we have elephant in the room. Okay. Let's talk UEC, Scott. How are things going over there? When will UEC start producing and at what cost and quantity?
Yeah, we're getting much closer to that point with the uranium price improvement. And, it has been an incredible year for, I would say 2 years for UEC, where we've made a number of acquisitions that have really caused us to be, I think, the fastest growing uranium company in the world today. And all that, focus being in North America, which is geopolitically a very attractive place to be. But we've made close to 600 million in acquisitions over the last 2 years in acquiring Uranium One from the Russians and building out our Wyoming capabilities, acquiring UEX and Roughrider. We now have a focus and a critical mass of projects in the Athabasca Basin. So it's really been quite exciting. I mean, it's been a tripling of our total resources, quadrupling of our licensed production capacity. So it's really an exciting place to be. In answer to your question, we've said that our restart plans are not dependent on getting baseload contracts. We have a 100% unhedged philosophy, which is very different than many other producers. I'm not saying that other approach is wrong. It may be something that other miners and developers have bank covenants, or their investors would feel more comfortable if they had an underpinning of contracts before they move forward. Our shareholders are quite content to see us unhedged and realize all of the upside price in the uranium market going forward. We don't have any bank debt or covenants, so we really have a lot more freedom. And we've said that that threshold for us is in the 60. We see prices trading in the $60 to $65 level, not just touching there and coming back, but maybe for a quarter at that level and seeming to be increasing from there. We'll really move forward into production. We've taken enormous steps at the mine sites. We're not waiting to get ready to restart when that price threshold's met. We've been taking steps at the Christensen Ranch Irrigary project to get the initial well fields, which were shut in 2018. It's really just a restart of existing infrastructure. So that can happen quite quickly. Literally in a couple months, we can be back in production. We've tested the flow rates in the well fields, and it's just a matter of injecting oxygen into the solutions to start recovering uranium. We've also, we don't want to just produce from the initial well fields. We want to also have our ducks in a row at the subsequent well fields, and so we've taken steps to initiate drilling and build out additional header houses and well field patterns, so we can not only restart production but sustain production. And so we're excited. It's not a huge capital lift for us. I think the total capital expenditures, maybe in the $20 million range the initial restart is very little, if any, capital required, but to expand into the new well fields at Christensen Ranch, we're talking about that kind of capital expenditures, which are easily handled within our own balance sheet. Texas is in a similar boat. It may be a few months behind Wyoming, but we're talking about the Burke Hollow project, where we've completed, kind of the first well field production area 1 monitor well ring. So we've prepped that ready for commercial production, and we're completing kind of preparation for the second production area at Burke Hollow. But there we would need to construct the ISR IX columns in the satellite field, and we've done that in the past at Palangana. It isn't, we're relying on the existing infrastructure, the processing infrastructure at Hobson. So it's really just an incremental investment there that would probably be under $30 million to complete that. So capital requirements of under 50 million to get uranium. Initially, it's going to be couple million pounds a year, but our goal would be to get up to 4 to 5 million pounds production from Texas and Wyoming within the next 4 or 5, 6 years.
Okay, you touched on Roughrider. Can you tell me what are the plans in the next 2 or 3 years for that project?
Yeah, it's very exciting. To acquire that project from Rio Tinto for 146 million in cash and shares. That was a project that was acquired by Rio Tinto for over 600 million, and they've invested over 150 million in sort of the development plans there that we've benefited from. To pick it up for the price we did was really incredible. But it also has synergies with our UEX acquisitions with Christie Lake, Horseshoe Raven, and projects in the Eastern Basin that we're drilling out and seeing very significant drill results and ore grades there. The idea would be to develop Roughrider and adjacent deposits as in a consolidated basis, and so we're performing those economic studies as we speak. And I think by October of this year, we should have those economic studies completed that will speak to production levels, timeline, cost to develop, and all that. So look forward to that coming in early fall, where we put some concrete plans and parameters around Roughrider. But we do intend to develop that. It's not going to be, initial production is going to be Texas and Wyoming. That may be 5, 6, 7 years down the road, but we do intend to develop that pipeline into production at some point.
Do you plan actively search more projects for M&A?
Yeah, I mean, I never say never, but I think we're in a really good place now because we have critical mass in Texas and Wyoming to really move forward and focus on production. In Saskatchewan, those acquisitions have provided synergies, and we have plans there to advance the ball in Saskatchewan as well. So I think we're probably pretty content for the time being with what we have, but we always have our eyes open.
Okay. Can you give me an update on Uranium Royalty Corp? What's going on there? What is new?
Uranium Royalty Corp, we're really, when we launched the company in 2019 and listed on the NASDAQ 2 years ago, we were coming out of a very, long and prolonged and deep bear market in uranium. And, there weren't a lot of mines in production or cash flowing. And, we launched at a time which people said, wow, you're getting into uranium royalties at a time when, there's very little production and development going on. Well, now, as we look back on it, the timing was ideal because the company's up and running. It has 147 million in cash and liquid assets, mainly physical uranium or uranium equivalents like yellowcake or Sprott shares.
Yeah.
18 royalties in the portfolio, a number of which are now back in production or getting back into production that will allow us to start generating cash flows this year. And we certainly have a nice physical uranium inventory of over 1.5 million pounds at a $43 average cost. So we're in a perfect position now to pursue job number one for URC is to go out and grow the portfolio, either acquire additional royalty or streaming assets that are available in the secondary market of existing royalties. But much more, I think 90% of our activities are focused on establishing new royalties as a capital provider to new mine development in the world. These 8 to 10 mines that are needed in the coming years, we want to be a capital provider that comes alongside of them to provide 20, 30, 40, $50 million in capital to help them advance towards production or get them over the hump into production. And I can say we're quite active on a global scale, talking to those miners, developers. I mean, we're an alternative to debt and equity. Debt is obviously very expensive with interest rates today. Yeah. Equity, a lot of the share prices for uranium miners have been, at closer to 52-week lows than highs, which doesn't make it attractive for them to go to that well. And even if it was, dilution of the existing shareholder base has to be taken into account. So I'm not surprised we're getting a really good reception on 5 or 6 files that we have on the go right now. So that's, that's an important point of any royalty company, their growth models. It's not the 18 royalties that we've accumulated and we just sit on those. No, we want to grow the portfolio dramatically in the coming months and years.
Okay. Can you tell me on what other commodities are you bullish besides uranium?
Well, I've been putting all my focus on uranium. Sometimes I'm asked, would you, uranium royalty, would you get into other sort of green energy commodities?
Yeah.
And as exciting as they are, like obviously lithium comes to mind, and seeing big consumers coming now and buying lithium mines to support their electric vehicles and battery operations. I think there's some exciting opportunities in there. I mean, the green energy transition, or just our technological society, is going to require more mined minerals, whether it's copper, nickel, cobalt, lithium, uranium. So I'm bullish on all those commodities for that reason. I think of all of them, though, I think the fundamentals behind uranium are probably as strong as any of those, if not the best, will be the best performing commodity in the coming months and years. I think that's going to lift, all boats in the uranium space, in this bull market that we're coming back into. But I think, like any market, I think there'll be companies that will outperform, and investors would be good to kind of seek those companies out. I think UEC, with low cost mines that are near term production, existing infrastructure, competitive on a global scale, that's an excellent choice. I think it has some of the best torque to the story of any uranium investment today. Uranium royalty is another very attractive way for investors to get pure exposure to the commodity, but have a diversified risk. With 18 royalties in the portfolio, some of those assets are going to outperform our expectations. I'm sure some will underperform, but if we've done our due diligence and we've really assembled the right portfolio, that's going to be a very attractive vehicle in this uranium bull market. So we're well positioned. That's the right commodity, right model at the right time. And UEC, with a near-term domestic production in Canada and the United States at a time of Russia, Ukraine, and unrest there, and issues with Kazakhstan, we couldn't be better positioned.
Agreed. Scott, I want to thank you for being my guest. It was a great conversation, and I hope we will catch up sometimes.
Absolutely. Thanks, Lucian. It's a great pleasure to be on the show. Thank you.
Thank you very much.